Okay, good morning, everyone, or good afternoon, I should say, and welcome to another edition of the Coffee Microcaps webinar series here. We are delighted to be bringing you two brand new companies presenting here for the first time on Coffee Microcaps. As always, I'm just going to quickly run through a couple of intro slides, and then we're going to get straight into it with our first presenters. For anybody who hasn't been on here before, my name is Mark Tobin. I'm the founder of Coffee Microcaps. You're very welcome if it is your first time joining us. If you're one of our regular attendees, welcome back and thanks for joining another session. As always, I'd like to thank RAS Researcher Service, who are our sponsors here at Coffee Microcaps, for their support, helping keep these events free for investors. If you are looking for some research on some small microcap companies listed on the ASX, please do check out their website. They've got some free content down there. You can also sign up for their RAS Plus service for some behind the paywall research. Quick compliance and disclaimer slide, and a very warm welcome to any of our friends from ASIC who are joining us this morning. For anyone who is joining us for the first time, companies we typically have on here are capped under 300 million in revenue, approaching cash flow break even, or indeed are already profitable. Tend not to have companies from the resources and biotech sector, but we do kind of cover then everything else, which I label as industrial microcaps, which covers everything from technology, healthcare, consumer goods businesses, engineering businesses, professional services, kind of anything that comes into play outside of resources and biotech. Structure this morning's webinar follow the normal setup. We've got two companies presenting 30 minutes each, which will break down 20-minute preso and 10 minutes of Q&A. If you do have any questions for our presenters, please type them in the Q&A box rather than the chat function. Just makes it easier to moderate them. And please note the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel on Monday morning. You can follow us pretty much on all the socials, Twitter, LinkedIn, YouTube, as I said, for the recording, and I do write a free monthly newsletter that goes out on Substack if you want to sign up there. Our first presenter this morning is going to be Adam Boyd, Executive Chairman of Volt Group, and then we are going to head over to Tom Dusseldorp from Australian Vintage as our second presenter. So I am going to stop sharing my screen and leave it there and hand you over to Adam, who is going to share his screen now.
I will. Thank you, Mark, for the introduction and everybody who's joined today. What I'd like to do is just to confirm, Mark, can you see the presentation?
I can, Adam. Yes, I can.
Okay, terrific. So what I'm going to do today, everybody, thanks again for joining, is I'm going to go through Volt's existing business. What has happened recently is we have made an acquisition, which is subject to shareholder approval. After I've gone through the existing businesses, I'll talk to that acquisition. Okay. So in terms of background of Volt, it was a company that we secured control of, the current board and management group, in about 2017, and we did that in order to execute a strategy of developing mining sector service and equipment technologies. Excuse me. I've had a little bit of a cold. That we could scale and would produce efficiencies, productivity benefits, cost reduction, and where possible, emission reductions for the mining sector. It was obviously a shell, and the initial business we bought was a company called Westcone, which is this here. Westcone is the owner of a proprietary sample crusher that is used throughout the iron ore sector. And I'll move to the next slide. So what was good about the business is the initial crusher had been developed and deployed throughout iron ore in Australia. That included BHP, Rio Tinto, Roy Hill, now Fortescue, and other iron ore operations. What's good about this crusher, other than the fact that we have it patented, is because there is no other competing solution in the marketplace. In about 2020, we developed a new crusher 2 years after we bought the business based on a need from BHP. We developed that crusher, patented it, and secured a 5-year contract with BHP. The positive of the business is that the crusher not only is proprietary and owned by us, but it's embedded in the port loading infrastructure at site. In terms of the contract with the steel mills that all the iron ore producers sell to, there's a requirement that they take assays of all iron ore that goes into the relevant cargo ships. It's an ISO accredited system that our crusher is part of. So in a way, it's kind of an embedded infrastructure in that for the iron ore miners to move to a different sampling system that doesn't use our crusher, they'll have to get a new ISO accreditation and agreement from all the steel mills to do that. So in that regard, the business is really embedded in the operations of what are long-term, high-quality mining assets. And that's what gives this business the longevity and the profit performance that it does. Its client base, you can see there in this slide. We are working to grow the business globally. So we have an agent in Canada, North America, that's Heath and Sherwood, and we have an agent in South Africa, which is MIT. MIT, who we appointed last year, they've been successful in getting Anglo-American to use our crushers, and we are deploying new crushers throughout their operations, replacing a previous non-West Cone crusher. We're also working, in fact, in Canada with Heath and Sherwood. We've just got an order to supply a crusher to a South 32 asset in Canada. Paladin recently deployed one at their Langer Heinrich uranium mine. So this business is continuing to grow, and its revenue and earnings performance, whilst sized for our business, its kind of profit margins are very good. So this year we'll turn over about 3.3 million in this business, and the profitability will be 2.5 million EBITDA. It has no capital requirements. So it's a consistent deliverer of earnings and surplus cash flow that we use to obviously fund our overhead, but also to invest in other technology development, which we have done in the development of this EcoQuip business. So EcoQuip, again, a separate business, is a market-leading solar lithium battery-powered light tower. It was developed to displace diesel light towers that are prolifically deployed across the mining sector in Australia and globally. There are a lot of solar light towers on the market. In fact, they're mostly all made in China. The problem with them is that they are not reliable nor have a build quality that suits the resource sector. So if you go to mine sites today, you'll determine very quickly that there is not a prolific level of solar light tower deployment. The diesel light tower deployment is still the most extensively deployed in the industry. That's because existing technologies haven't had the illumination performance or the power budget durability to be reliable. We set about creating a product that could realistically and authentically displace diesel light towers. And we've done that in two ways. We've worked with a US Army, a private fabrication contractor that does a lot of work for the US Army. All their fab shop, which is extensive, and their paint shop complies with US Army standards or specification requirements. And as a result, our equipment goes through that workshop and paint line. So we end up with a very robust fabrication outcome. What we also did was we developed a charge system that's significantly more efficient than off-the-shelf charge systems that are deployed in competitor products. That charge system we developed ourselves with aerospace contractors in the United States. That's been very successful, such that our round trip efficiency is in the order of mid 90s, let's call it 95%, where a traditional system is about 80%. So we have substantially increased our charge efficiency. The other thing we've done to give the illumination performance and power budget longevity the capability that's needed is we've reduced or improved the efficiency, reduced the power requirements of our LED luminaires. So we're at about 30% more efficient than any other LED. What we found was not much energy efficiency development's been done on LEDs since they were originally developed to replace halogens. There was so much of an efficiency gain by replacing halogens that nobody has done a lot of work on enhancing energy efficiency of lights. We did a body of work with a partner also in the United States to achieve that. So overall, what we've done is achieve a product that you can see here in this picture that is the first that's actually capable of displacing diesel light towers. Not only can it do that, but it's zero maintenance, zero OpEx, and we rent them to the industry. So the cost of renting our machine with zero OpEx and zero maintenance and no fuel requirement is about half the cost of renting and maintaining a diesel. So a diesel has somebody that has to go and refill them. They've got a light vehicle, they're driving around a site. They have to obviously service the diesel engines, which means every 250 hours they're taking them from site to a workshop. They've got to just change the oil, dispose of oil filters, dispose of components that need replacing. They've got tradesmen that they need on site. They have to fly up, feed and accommodate to do that work. So it's a solution that removes the need for skilled labour, removes fuel usage, and it improves obviously the carbon footprint and the cost performance at mine sites. So, for example, we've done a lot of work with Westgold. They've just started to deploy our light towers to displace all their diesels on their sites. Ultimately, it will save them, once they're fully deployed, maybe $5 an ounce. Now, that's not a huge amount, but in a world with cost escalation coming, they're quite keen to make any savings they can. Our biggest deployment was to Chevron. The product, or the EcoQuip product, displaced all the diesel light towers used operationally on Barrow Island at the Gorgon LNG project. We signed a contract with Thiess about 12 months ago. The Thiess don't use the product as a light. It uses the product by replacing the lights with their autonomous mining system technologies. So they use it for network reinforcement at mine sites where they are the mining contractor. And we're also trialling with McMahon. So this business is now profitable as well. We've crossed the valley of death in terms of that technology, and our aspirations for 2026 is to embark on an extensive sale execution and increase the size of the fleet. The potential of the market is here. EcoQuip turns over about $2.5 million a year at the moment. Excuse me. The market potential just in the Pilbara is at least in the order of $100 million worth of rental potential if we replace the thousands of light towers in the Pilbara. And we're certainly focused on the mining sector in WA at the moment. The exciting thing about EcoQuip is its growth potential, and our ability to fund CapEx is just provided by the surplus cash flow by our Westcone business. And we have equipment funding facilities with Westpac to part fund any new fleet that we build. In addition to that, of course, we've now come to terms to acquire a business called 4D Delta. I'm just going to flick to some slides on that, which I'll then end with a sort of group forecast of cash flow performance. So 4D Delta, we've been working on this acquisition for about 12 months with the two vendors, the two shareholders of it. It was established in 2014, but transformed itself in 2021 by developing a proprietary software application with a really unique and terrific capability. So what 4D Delta is it's a digital asset inspection company. So it's inspecting assets at mine sites. This picture you can see here is of the inside of a rotating kiln. And that's been taken by a LiDAR scanner. So LiDAR scanning itself is a relatively new technology, but any of us could learn how to execute a LiDAR scan with a little bit of training. So what 4D Delta will do is it will present to an asset that's subject to wear, whether it's a chute in iron ore or a bin or a hopper, whether it's in a business or a industrial mineral processing business. It could be a calciner, a kiln, or an autoclave that are all lined with bricks. They deteriorate, and it will, during a maintenance shutdown, 4D Delta will take multiple scans of an asset to discern its wear status. And of course, you can see this scan gives a heat map associated with surface changes with respect to the asset being scanned. What 4D Delta does that's different to everybody else is its software is able to combine multiple scans and deliver a very high resolution image, 3D image of the actual asset. Now that capability isn't that new. You can use off-the-shelf software packages to provide you with a heat map of wear on an asset that's been imaged by a LiDAR scanner. What 4D Delta's software enables it to do simply is to also layer the scan results over the native design files of the asset, and also, if needed, the external imaging that they might do of the asset. What that then does is give a clear picture to any reliability engineer working for a client of the actual level of wear in accurately measured context. The type of thing you see on this picture, you can't actually discern how much wear is there. You just get a relative color map. So this is the process that we can outline that 4D does. It takes a LiDAR scan of an asset. Let's say it's a chute at an iron ore mine. It then takes that data, which is uploaded to its portal from site, and its people at a specific location will look at the raw data to determine whether there's any kind of problem with that data. And where there is, they will resolve those issues. The data then gets submitted for processing, which will deliver an image and a result that, after QA and QC, is uploaded to the 4D Data portal, which clients can go to and then have a look at the specific results of the test from their office, wherever they might be working, whether that's on site or in a city office. Excuse me. The market opportunity for 4D is substantial. Bulk materials handling, that's the iron ore industry. Its biggest clients today are BHP and Rio Tinto. It's still at an early stage of its market development, so it hasn't approached or had much interaction with any of the other iron ore miners, but the potential there is significant. The refractory market, as I discussed, that's the type of assets that are scanned there, kilns, calciners, or autoclaves. The business does a lot of work for Alcoa and South32 at their alumina operations in WA. That's a part of this sector. And they've started doing mills. And some of you who understand the resources industry in WA will know that the remote mine site areas are prolifically populated with mills doing crushing of ore as it presents to their processing facilities. They're full of liners. All that needs to be evaluated on a regular basis. And 4D Delta is starting to push into that market. Given we're running out of time, I'll just run through a bit of this. This is an example of a chute with wear liners. The same thing happens in this circumstance as it does in refractory. What we found, what our due diligence found is that once these miners and the reliability engineers start to use this tool, it helps them rationalize all the decisions they're making about shutdown period, and also which wear liners or brickwork they're going to replace. In the past, they haven't had any data to support the positions that they take in terms of the level of maintenance required. They've just inspected visually and then made decisions based on that. So there's been no data, actual data to support their decisions. What 4D gives them is a comprehensive suite of effectively wear measurements and the ability to forecast when wear will hit thresholds that need to be dealt with or get to the point that highlight that the relevant wear product needs to be replaced. So once they start using it, as you can see from this market penetration data, 4D deployed their new platform and capabilities in June 21, and you can see each year there's been a fairly steady and positive level of growth achieved. This is only one quarter here, whereas you can see these are annual changes. So we're quite excited about the fact that there's an enormous market potential in the refractory and bulk materials handling here and mills in WA, let alone how this could be applied globally, because it's a scalable business in that you could be scanning an asset, let's say a kiln or a calciner at a cement works or an alumina process in Africa or in Europe. Once the scan's captured at the site where in Europe, say, it's immediately uploaded to the cloud platform, and the 4D Delta people in Perth, where they're located, will deal with that, process it, and then submit to the portal, and the reliability engineers can present to that via the 4D Delta portal. So it's an excellent, the capability is outstanding in terms of its ability to globally grow. In terms of this acquisition, it's still subject to shareholder approval. That's the final approval required. We secured commitments for $4 million to help us fund the cash component of the acquisition. We paid $7.25 million for the business. That's about a 5 times EBITDA. Half of that 7.25 in cash, and the vendors have agreed to take the other half in vault scrip. So they'll become, approximately combined, the two vendors of 4D Delta will own approximately 17% of Vault after the transaction. They get some contingency consideration as well. So, and then 2 years after the acquisition completes, to the extent the business earns more than 1.5 million EBITDA, they'll get 75% of that money. That's capped at 2.25 million. I think now I'll move on to this earnings vision that we have for the business. So our budgeting for calendar year 26, you can see our Westcone business, EcoQuip here, A10, which is a technology that we haven't commercialized yet. I haven't gone into that due to time constraints. And then there's 4D Delta. So you can see next year we're looking to grow the business from what I think in 2025, subject to the next month or so, will be about 6 million in turnover. We're increasing it to 11 to 12 and hopefully we expect to deliver an EBITDA of, let's call it 4 to 4.8 million next year. So we're a small business, but we're quite profitable, and we clearly were able to do that because we've developed or acquired niche technologies that deliver efficiencies and cost savings for our customers. And at the same time, they're able to pay us what is a fair compensation for the products we deliver. We've done a medium-term target. This is a 3-year forecast out, and that's what we believe we can achieve. This has some growth assumptions in it, but imminently doable. We're already growing in Africa. We've deployed 2 of our crushers. Westcone has their Fortescue's Iron Bridge project, and they're commissioning that section of the plant in February. So we'll get more service, repair, and sales opportunities from that. EcoQuip, based on only deploying 120 light towers in the next 2 years, this is the sort of EBITDA result we get. We think that's imminently doable. We have 80 deployed now. This is our A10 technology. It's a waste heat to power technology that I'm happy to talk about in question time, but this is for the development of a small 15 megawatt project we're working on at the moment. And then you've got our 4D Deltas medium-term outlook, which is, we believe, given the growth that the business has achieved to date, that we'll be able to continue to present to markets in the Pilbara and Western Australia more broadly, as well as overseas, to generate that kind of growth. So this is the sort of revenue outcome we think we are close to being able to achieve in the medium term. Mark, it would look like we're getting short of time, Mark. Should we go to Q&A?
Yeah, I just sent you a message there, Adam, actually, to say let's get into a couple of questions. Just in terms of, if I could focus on Westcone for a second, the replacement cycle on the crushers, like how long before they're like BHP or the guys who are right here are coming back to you, looking for a new one, or they have to be serviced, recommissioned, refurbed, whatever it is.
Yeah, okay. So it depends on where it's deployed on the site. So the crushers are deployed at port, where they're very busy. Every 500 tons that goes in the ship, they take a 500 kilogram sample that goes through the crusher. So the crusher's dealing with 500 kilograms every 10 minutes. There's multiple crushers at port. They also have them at the mine sites and in labs. So the port ones will last between 4 and 9 months. The mine site units will last around 12 months. And the lab units, of which there is less, they'll last up to 4 years. And that's all about the level of duty that it is presenting to the crushers. About 80% of our revenues is from recurring repair work.
Okay. Great.
Does that answer the question?
No, it does.
Okay.
And the EcoQuip units, are they also manufactured in Perth, or are they manufactured in the US?
So all the metal, fabricated metal, is made in Ohio in the US, and the power management controllers and luminaires are manufactured also in the US. So it's all shipped to Australia in components, and we assemble the light towers in Perth, in our workshop in Perth.
Okay.
And the reason for that is it's much cheaper to do metal fabrication in the United States than it is in Australia. And it's also, we don't have the kind of capabilities in Australia to manufacture the level of complex primary circuit board and to develop the software and firmware we have for our product here. So that's why we went to the United States, because that's where the capability was to create the technology step changes we needed to make the product perform in a way that the clients require.
Okay. And the EcoQuip typical rental contracts, are they like a 6-month, 12 months, and maybe just a very quickly expected, I don't know which way you measure it, return on assets, return on
that's okay.
On equity, just quickly on that, if we can just squeeze it in.
The simple metric is it's a 20 to 22 month payback for each tower. on the basis that we rent them. We don't sell them, we only rent them. The contract terms do vary. We give a pricing cascade, so the longer term the customer commits, the lower the monthly rental charge, okay? So we've had a 5-year contract with Chevron for Barrow Island, down to, 6 months for people who want them for a shorter term or just don't want to commit. They end up keeping them once they're on site for a long period of time generally. Once people are resistant to change, I've found in the mining industry, but once they get the EcoQuip tower, the users are generally quite happy with it because you don't have to refuel them. It just simplifies how they manage light towers. There's no maintenance, no OPEX, no people needing to go and perform maintenance. So the simplification wins them over.
Okay. Adam, we'll leave it there, and I'll wish you well for getting the final I's dotted and T's crossed for your 4D Delta acquisition. Hopefully, we can get you back in 2026 to give us
Yeah.
an update on how you're tracking.
Yeah, you can check the scorecard and see how I went.
We will, and I'm
Thanks
sure
to
you'll.
everyone who joined and was interested to
Uh,
listen to the vault story.
and I'll let Adam go check the scorecard of the Ashes there in Perth now for the rest of the day.
All right.
All right, thanks, Adam. And we can now hand over to our next presenter, who has been patiently waiting in the wings there, Tom Dusseldorp from Australian Vintage. Tom, good morning.
Morning, Mark. How are you?
I'm good. Tom, if you want to share your deck, I'll let you know when I can see it coming up. Yeah, it's just loading now, Tom. Yeah, if you just go to slideshow mode there, please.
Yeah.
Yeah, that looks perfect, Tom. Maybe just tilt your camera a little bit back there just so we get you fully in screen there. Yeah, that's great. Thanks, Tom. You can take it away whenever you're ready, mate.
No worries. Thanks, Mark. Thank you, everyone, for attending this webinar. Quick background. So Australian Vintage, we are a publicly listed Australian wine manufacturing business. We've been listed for the better part of nearly 30 years. This business is the amalgamation of a long heritage of wine consolidation under the McGuigan wine family. So Neil, Brian, Lisa, McGuigan, Hunter Valley origins. But we're a much broader consumer goods company now. So McGuigan family left Australian Vintage the better part of 6-7 years ago. And we've really been operating more as a more professional FMCG beverage business, really evolving, what was traditional wine into something a little bit more modern and contemporary. Why I'm speaking to you all today is that we are on a turnaround year. I recently took the CEO role 5 months ago. And really the mission of the business now is to turn around what has been a number of years of poor performance, poor cash flows, inflationary pressure. And so, my remit now is to return the business to free cash flow and to really navigate what is a phenomenally stable global business back to its former value. We currently trade at a market cap of 40 million against an NTA of around 300 million. We're incredibly undervalued, but it is reflective of a number of years of poor performance. So a phenomenal opportunity for anyone who resonates with this story. All of this is publicly available. We obviously have phenomenal amounts of information available for any scrutiny, but I'll just run you through kind of the thesis. First and foremost, what makes up Australian Vintage? So we are a global business. We're distributed in 40 countries. We do last financial year 257 million revenue, ASX-listed. And really, we've got a lot of phenomenal assets. There's not a lot of companies that will come to you projecting growth that do not require significant capital to unlock that growth. We sit on the third largest winery in Australia by crush, so roughly 150,000 tonne capacity, to give you some sense of literage around It's around 700 litres a tonne, if you want to do the conversion about what that means from a finished good wines perspective. We've got some really good core brands. So McGuigan, Tempus Two have global resonance and have really built a phenomenal wine business over many years. The McGuigan family have a huge legacy in wine. They've achieved what I call unicorn status. McGuigan contributes roughly around 140 million to our 257. So it gives you a sense of the scale of these brands. We're the number one leader in low and no alcohol. So we're the largest still wine, zero alcohol provider in the world. Why does that matter? It's on trend. It reflects innovation, an innovation mindset, and it's much higher margin, much higher value. We're also a B-Corp, as you will appreciate, for global FMCG companies that lean on retailers. ESG is much more at the forefront of our business model. It's a ticket to the game to sit with Tesco or Woolworths or Endeavour Group. You need to be representing the best in ESG reporting and standards. So B-Corp, for a company of our size, we're one of a handful in Australia, if not globally, on the listed markets. And really, we have phenomenal relationships. The great thing about this business is that we do 257 million in revenue, and we sell two big brands, Tempus and McGuigan. Our equivalent competitive set, Treasury, Vinarchy, which is the combination of Pernod Ricard and Accolade, they sell hundreds of brands. So there's a huge opportunity in which we can grow in a really nuanced way through both better efficiency and new brands and new propositions and innovation. So what is underpinning the strategy? The four key pillars that are going to change the trajectory of the business is pillar one of the most obvious. Free cash flow is my clear target from the board. It's something we've communicated very broadly to our investor base. We're going for plus 20 million free cash flow. This isn't a big, hairy, audacious goal. This has been achieved in the past. So we have precedent that this company and business and our supply chain can achieve those levels of cash flow. And this year in FY26, we're going for a cash neutral goal as step one, then plus 10 and then plus 20 over the 3-year plan. How we'll get there, we need to reduce our inventory. Most wine companies are all vertically integrated, either owning vineyards or tied up in supply contracts that are very inflexible and multi-year. So as consumer preferences change, you must take that wine at potentially increasing prices that obviously absolutely kill your cash flow in the business. Increase your inventory and effectively your assets, but if they're non-saleable or need to be readjusted, they can become very big anchors on businesses. And we've seen that in the history of the wine industry. So we're actively exiting leases. We've announced those to the market, and we're going to reduce inventory by about 40 million litres over the life of the plan, which is quite significant for our business. New markets will play a key role. They are not what the whole plan is based on. Asia, I talk specifically about Southeast Asia, some phenomenal opportunities across, markets like Thailand, Philippines, Korea. These are markets that aren't normally called out in a lot of, Asia forward views. China tends to get the dominant focus, but for us, we're seeing a lot of traction in those Southeast Asian markets. Yes, China is relevant, but we haven't anchored the plan on it. And North America, everyone throws North America in the global market expansion mix. We are quite big in Canada, and we have a very, very small aspiration in North America with some early traction there, and to generate around 20 million. So it's not going to be the game changer for the business, but will contribute significantly. The really big one is innovation. Innovation will deliver over 40 million of incremental revenue. That's going to grow each year as innovation becomes more and more part of our business. So they're the underpinning drivers of the plan. I'll quickly go through now kind of what's the thesis as to why Australian vintage is a good investment in terms of where we sit in the market and what we've got coming through. First and foremost, there's a lot of narrative about liquor or alcohol as a future structural decline. I always use the analogy, we used to sponsor Live Nation. Live Nation is one of the biggest event organisers in Australia. They've cancelled more festivals in the last 2 years than, they've put on. Why? Do young people not like music anymore? No, they just consume music in a completely different way. And what I like to always lead with is that, the Wall Street Journal did a big kind of alcohol expose, and one of their really interesting graphs was this idea of X billion per month dollars on booze. And if you look at how alcohol has trended over time, yes, there is declines, but it is relative to the COVID alcohol boom. This is a significant moment in the alcohol industry because I think everyone can reflect being locked up in their places. If you do enjoy wine or your choice of beverage, we all drank way too much. It was one of those periods where alcohol was getting a lot of tailwinds. And so when you look at data and you're looking at declines across, different alcohol categories or alcohol in totality, yes, it is in decline, but if you look at the pre-post pandemic, there's still lots of healthy growth in different parts of the alcohol industry. It is not a total structural alcohol problem. What does that mean for wine though? Because we are in a wine industry, and you can see the latest category data shows that wine is, back in growth. Now this does fluctuate in year on year, and the directional long-term trend of wine is decline, but there's a reason for that. What's changing? Wine is morphing. Those traditional wine occasions are no longer as relevant as they once were. You think about boomers as a demographic, big heavy reds, lots of dinners at home, family, those occasions are becoming less and less. And across the board is we're drinking less but differently trend, moderation, convenience over lifestyles. We're seeing occasions changing. They're more social, there's more connection, more meaningful connection than just traditional format styles. And preferences. People are wanting flavor, they're wanting fun, they're wanting sparkling and lighter styles are emerging within the wine industry. And I love a bubble graph because I think it's the best way to reflect volume and growth. And you can see all the red dots or the large bubbles are your heavy reds. They are in decline. They are still a huge part of the wine industry. And so there's this reset in terms of the lighter styles trying to make up for the volume and value decline of heavy reds. Prosecco, sparkling flavor, rosé, Pinot Grigio, like all of those styles in phenomenal growth, but obviously trying to offset, red blends, Merlots, Cab Sav, Shiraz, these are the ones that are actually even at a higher RRP. So the value of those are significant in terms of the wine industry. AVG, we sit on a phenomenal core brand portfolio, as I've said, Tempus, Nepenthe, Barossa Valley. You see some size and scale there. We recently acquired Madfish, which is a Western Australian brand, international distribution, the brand in international markets, 200,000 9-litre cases. So, whilst we do have some cash flow challenges, we are still doing acquisition deals out of cash flow. But what is the most interesting is our new and our innovation portfolio that I'll kind of showcase it through. So the recent acquisition of Madfish will strengthen the portfolio because in the UK, we are very McGuigan centric. So we need to have a more premium portfolio that we want to trade people up to. So Madfish sits at around £10. £10 to £8 is premium in the UK. It is considered the top end of that kind of more volumetric wine consumption market. It's a phenomenal brand that has achieved really good cut through, but the owner didn't have the capacity to leverage it internationally. And so we leveraged our international scale expansion. We acquired it for a very reasonable deal, and we're already in the process of accelerating it, which will contribute significantly to our H2 growth ambitions, which I articulated at our recent AGM. Going on to flavour, Lemsecco, aperitivo occasion, spritz. This has been a phenomenal boom for the liquor industry. Traditional wine losing relevance, flavour and RTD flying, wine not getting its share of that occasion. So it needed a format and a style of drink to really access that moment. And spritz was born. We entered the market last year with Lemsecco Lemon. We are now in availability over 4,000 stores. The product is absolutely flying. We've gone from 1 SKU to 6 across 3 flavors, and we're seeing really, really good repurchase rates. So this This gives us a lot of confidence that we are absolutely in the right space. This will launch in the US in the next week. It sold out in Canada. We have a listing in Sainsbury's in the UK. So as you can see, a traditional wine company like AVG leveraging its infrastructure globally with innovation on trend, we get a disproportionate share of that shelf. So it really indicates that we have the propensity to drive that revenue growth going forward. Our forward projections are very moderate, 6 million net sales into this financial year. And this is another key point. This is all very margin accretive to what traditional wine brands are able to dominate or claim within the market. Wine is seen as not a high margin product for a lot of businesses unless you're in the over $20 per unit price point. But our scale and efficiency allows us to generate margin accretive innovation that we can access into those markets. So it's a really positive momentum for the business as we move away from kind of sub-10 wine. The big one though is the little one, Poco Vino, a little wine. This has been a phenomenon for our business in basically the last 3 months. I've been talking a lot about this as it was coming online. Now it is online. But what's behind it? Anyone on here who's a wine drinker will resonate with one of these tensions. It's hard to discover new wine. So if you're a younger consumer or you like a certain varietal, it's hard for you to want to go across to different categories. What's good? What isn't? What do I choose? It's got a lot of issues. When you're trying to moderate your booze consumption, what do? It's the 750ml bottle of wine. It's 7 to 8 standard drinks. It's a huge commitment. So what we're finding is a lot of the wine consumption declines are coming midweek. It's that Monday to Wednesday moment where you don't want to pop a bottle because it's a huge commitment. You'll either drink it all and not really like yourself the next day, or you'll tip it down the sink. And again, it's wasteful. And that's that kind of fourth theme around wastage. Also, there's choice anxiety. I like red, you like white, we're in for 2 bottles. So let's just grab a G&T. So you can kind of understand there's a lot of tensions with traditional wine and how it showed up in the market. But there's lots of case studies of companies in macro decline that have pivoted to grow. So Coke Mini, Toblerone Tiny, confectionery snacking, these categories, these companies are claiming higher margin because they're solving a problem for consumers. And wine companies were just not geared to be able to do it. So what we did was we kind of broke the mold. We created this product, Poco Vino, 187 mils. So a generous glass, 6 varietals. We've actually got 7 globally. And we went and tested a huge amount of consumers, 3,000 globally. I've never done this amount of quant. They all validated that this was something that they were willing to buy and wanted to buy, and that they would buy in addition to what they do now. 81% purchase intent is phenomenal, and 47% accretive. We didn't want this to reduce what we call average weight of purchase of basket. We wanted it to increase it, and so the data was telling us that it would. 2 jobs: recruit new consumers. So the next gen are coming to wine later. How do we get them in, enjoying it, removing those barriers to get them to taste and try and really engage? So this is what Poco Vino is doing. And also bring current consumers back. Like, I'm a midweek wine drinker. I drink less. I love the Poco Vino Pinot Noir. I have 1 or 2 in the midweek, which usually I wouldn't have any because I can't open a bottle and I don't want to commit to the whole amount. The other innovation around it is wine is often very hard to get variety. So we've done a multi-buy mechanic so you can get a discount or progressive on multis. So 1 for 7, 2 for 12, 3 for 15. It drives increased purchase weights. And we've been really thoughtful about the price point. There's no point bringing innovation and making it so expensive that people can't engage in it. So in the UK, it's £3. In Australia, it's $7. In the US, it'll be $5. In Europe, it'll be €5. So you start to get the sense that it's premium but accessible, and that is where a lot of the minis of categories land. A Coke Mini, for example, you're paying nearly 110% on top of what you pay for a 1 litre equivalent. So people are willing to pay more when they get a problem solved for them, and it's something exciting. And hopefully you can see the way it turns up is incredibly disruptive to current wine. Here it is in store. It's a multi-location proposition. These are real in-store pictures in live now. On shelf in Morrison's on the left, in New Zealand, in the fridge, FSDUs, Impulse on countertops in every Dan Murphy's and BWS in Australia right now. It's very disruptive. Why? Because people shop with their eyes. Wine is a wall of sameness. So how did we disrupt it? We turned it on its side. We got inspiration from global travel retail. We got inspiration from Nespresso, High Smile. The way that retail shops really help navigate quite complicated categories using color and signposting. So what are the results? So these are really kind of fresh off the press. In the UK, our rosé is the #1 SKU. So it achieved 12 units per store per week in its first week and has settled down to 5.3. To give you context, good wine units is about 1.5 to 2. If you're at 1.5 to 2, you're doing really well. Our range is doing an average of 5.3 now across the portfolio, which is a phenomenal achievement, which is just the beginning. We're in 1,200 MFG petrol forecourts. We're seeing turns of around 1.5. So that's convenience right now. That's in a completely different channel. But we're really happy with the build of that. In Australia, we've done 1.15 million in scan sales in EDG. We're selling 2.5 in BWS and 5 in DANs. Like, these are kind of phenomenal sale rates. We outperformed hard rated orange, which sounds like a weird brag for a wine brand, but there is no wine buyer that's beaten an RTD in terms of innovation sales. I don't know if ever, but it's just showing you the appetite and appeal for this and what the potential scale of this could be. New Zealand, it's flying. We're in pretty much every store. And as you can see, they've even invested in fixtures. And so the future of Poco Vino is more of a fixture-based selling turn up. But what's the opportunity? We're scaling globally. You know, we're about to launch in Thailand. We've confirmed Hong Kong. We're in final stage of Korea and Japan. Final stage of Europe in Delhaize and Albert Heijn. Tesco Islands confirmed. So you start to get the sense that our estimates of growth were only ever based on Australia, New Zealand, and UK. So as we grow, those estimates will increase as we see the rates come through. So you're really seeing an advanced view of what this potential of this brand could be for this organization. We set a target of 8 million in year one. We upgraded 15. We've set 20, 30, but those were based off the 8 starting point. So you start to get a sense of just how big I think this could be. And this is before I talk to you about what's coming. Other innovation is about how it's made. I won't get into too much detail, but we're innovative in our sourcing and packing strategy. So Europe is French wine made in Europe. We don't ship from Australia to Europe and back. That is not how we're going live. And so Australia funds or services Asia Pac. We have a line in USA, which will service the US and Canadian market. Future state, we will have one in China, in India, servicing the local market with local wine, protecting us from geopolitical, supply chain cost risks, environmental risks, bad vintages. So we're really insulated from what are current risks on location-based wine sourcing brands. The other thing is it's incredibly margin accretive. So this is a black label, our bread and butter business. You can see that we're significantly higher on a CM per 9 litre case equivalent, and that's only going to get better. So as this becomes a bigger mix in our business, I'm going to move our gross margin, which is currently sitting at around the 27% mark, because we do a lot of bulk and we do a lot of sub 10. As this becomes a bigger part of the business, those margins are going to move up north of 30, which is absolutely the goal. Outside of just free cash flow, we're going to improve the profitability over the term. We're everywhere. If you're on social, you will be seeing Poco Vino blowing up in your feeds because it's very shareable, it's incredibly disruptive, and young people are loving that TikTok ability of it. And we've got plenty coming in the pipe. So we've got sparkling, we've got spritz, we've got premium ranges, we've got gifting, we've got global travel retail, which you could imagine would be a phenomenal channel for you to pick and mix, discover and gift wines of the world. Really, it's unlimited to how Poco Vino can turn up and the premiumness we can take it. That's where you really unlock, like Treasury, who is a phenomenal market cap business because of the power of premium brands. If we can take this into premium, then we start to transform the shape of our P&L. So that's Australian vintage, and hopefully I've convinced some of you that there's an opportunity there, but open for questions, Mark.
Yeah, thanks, Tom. We've got a few here that are coming already. So we'll just take them in turn here. Given you're reducing inventory, should we expect some of this to be sold at a discount thus impacting overall gross margins? And I might just add to the end of that, or is it a case of as you roll off leases, there just isn't as much inflow coming in, so it just kind of naturally stock levels naturally go down?
Absolutely right. So we exited 2 vineyards or 2 leases, Millawa and Balranald. What that did was reduce a phenomenal amount of red wine that we had no longer any requirement for. Our natural demand is around 70 to 80 million litres. And so we're only going to bring in around 60,000 tonne. So again, if you do the 6 times 7 versus the demand, you start to get the delta between what we need and what we have. Now, that's to get us in balance, right? I'm not going to do that all the way through to zero. Wine companies need about a year supply cover because you only get vintage once a year and you don't want to be left short. But our business has been phenomenally out of balance. And so over the last year, you've seen a lot of disruption in our company pre my time around inventory write-downs, board disruption, different strategies. That's not how I'm operating. It's all about keeping us as in balance as we can be. So no, you shouldn't see that erosion of margin. In fact, what we're finding is we're buying wine finished, in some cases cheaper than we can make it for ourselves because of the sunk or fixed cost aspect of wine supply. It can be, challenging to improve your COGS.
Okay. Next one. It seems like you're being really aggressive with advertising, more enjoy for innovation, investment in new bottling lines, debt increasing by 30 million to December. The kind of question is, how quickly are we going to know that, this is kind of paying off, or, I guess probably the question is, when do you expect to start seeing it coming through the numbers? All this is kind of happening.
Yeah.
It's in train at the minute, but, should we start to see it in 12 months time, 18 months time, 6 months time?
Everyone's going to see it on June 30 full year results.
Okay.
I'm out telling the story of what's coming through is because you're going to see it with everybody else. So we're looking at a phenomenal H2 because all of the innovation has landed in October. So we've got kind of 2.5 months benefit of the revenue of that and margin. So our half, we're actually flat on prior year, which is a really good result in the current dynamics of, sub 10 red. Second half, we will accelerate out. We'll have our Madfish acquisition come on for a full 6 month plus all of the innovation for a full half. And we're targeting a 5 to 7% growth, which most wine companies in our position will get nowhere near that in terms of their portfolio. So that's one thing to look for. And we're on track for that. I updated the AGM on that. The other thing is I will not increase net debt. So net debt at June 30 last financial year was around 75, 76 million. We have had quite a lot of H1 cash outflows. Why? Because we pay all our growers in H1. It's about 22 million of cash goes out in the first half, a bit of working capital on Poco Vino. So we've had a bit of cash upside that we had fully expected in our forecasts. We will recoup that in the second half. So if someone's asking me categorically when will they see it, they'll see it at the end of the financial year announcements, because that's the ultimate goal and when I announce it to the market. But we're already seeing Poco deliver above expectations. We're already seeing Lemseco deliver above expectations. We're on track for our core brands. So you won't see it in the numbers at the half, but everything directionally is absolutely on train for what we've announced that we're going to do.
Okay. And just let's say we get you're launching, Poco Vino, as you kind of say now, and, then we're going to start heading into Northern Hemisphere summer, which is, as you listed the markets there, like where's Ireland, the UK, the US, if Poco Vino goes exceptionally well, does that mean a recalibration of the stock inventory? I'm just trying to balance out, you're trying to get inventory down, but yet you've got a new wine brand that's also taking off. So it's how do you kind of marry the two?
The best thing about it is that Poco Vino taking off is only 187 mils a unit for $7. So the volume implication versus the dollar contribution for convenient small format products is just where we need to be as a business. 750 ml bottles of McGuigan Black Label keep the lights on for our business, but every one of those is for $6 or $6.50. So as you can appreciate, the volume to value equation in 7 750 mil is phenomenally bigger impost on the business than what we're doing. We're also able, by procuring in market, so in Europe, it's French wine. I order that French wine, it is delivered within 4 working days, and that's when I pay for that product, not the 22 million that I just invested in all of my lease vineyards that feed my natural 60 to 70 million demand. That is a huge cash drain on the company. This Vino range is almost like a just-in-time model, which allows us a lot of flexibility around working capital, inventory management. We actually can be much more agile with how we supply the market, because it's not sitting on a boat for 3 months in 24,000 litre containers. We can be a lot more kind of thoughtful. So Poco Vino for me, I want it to grow as fast and as wide and as quick as I can. And what that means by having 3 investments in lines is I've got capacity that I can fulfill that right up to where we are today. We've already scoped speed lines, and what's great about the capital to support this product is it's 2 to 3 million Aussie. It's not 10 to 30 million a line for high speed 750 mil throughput lines, because to get high speed, high volume, these lines need phenomenal capacity in which to service that demand. Whereas being 187, the quicker fills and they move through faster. So you're getting more units on a per basis. So even the COGS are better. So I think, there should be the question around working cap and how can you maintain that growth. But what it converts to is so much better margin wise that it just feeds itself as it starts to build momentum. And that's just still wine. Sparkling will double the brand. So every number you've seen doesn't include any sparkling, and it sells nearly 2 to 3 times the rate of sale as still wine. So as you can appreciate, it's going to start to become a very big proposition.
And am I correct in saying that the Poco Vino, if you're, buying it direct, it's delivered, bottled in market, you sell on to retailers, wholesalers, distributors, they pay you 60.98. The whole working capital cycle versus a traditional 750 mil thing is also way, way shorter. Is that correct?
Depends by customer. We all have different payment terms by retailer. Asia is great for us because it's all FOB, so it's all a net sale. As soon as we sell it, it's converted into the business. But there is a bit of a lag on the working cap, but it hasn't been as big an inventory build as we thought it would be. And now it's in market, we're in normal flow. So we're seeing those cash flows come in and they will build as the full 6-month delivery looks like. And that's why, we will get back to that net debt number, which is 75. That's the true test.
Yeah. And then, another question here on net debt, we might as well stay on it. What do you consider a comfortable level of debt long term, whether it's a EBITDA multiple or a net debt number or whichever way you want to look at it?
No, look, I've spoken to a lot of investors and analysts in my role. There's lots of varying views on what is a comfortable debt level. My view is I kind of resonate with the 2 times EBIT is probably the industry benchmark in terms of a debt position. But that being said, debt, as we all know, is not a good or bad thing. It's a leverage that you can use to either accelerate or stay afloat. And there is no doubt, and no, I'm not being avoidant at all. The last 3 years, debt has been used to bank inventory that has built up into the background that we're now moving through and starting to get back in balance. That debt should not grow unless I have a meaningful acquisition or I have a phenomenally margin accretive investment, that I transform the top line or the bottom line of this business. Otherwise, that debt will come down. And so if I can get it to that 2 times EBIT, which is like, 30 million or sub 50, around that mark for our size and growth aspirations, that would be a really good place to be at. Hence the goal, 0, 10, 20. The 10, 20 gets us to that mark over that 3-year plan. So it's all aligned to that outcome.
Okay, perfect. Tom, we've gone slightly over time. I don't want to take up any more of your day. So thank you very much for joining us. And good luck with the Poco Vino launch now over the Aussie New Zealand summer. And hopefully we can get you back in early 2026 and you can give us an update on how all these new initiatives are playing out.
It'll be great, Mark. Go and buy some.
See you, mate. I've got to message my sister now because Poco Vino would be right up her alley.
100%. See you, mate. Thanks again.
Cheers, mate. Bye. And we leave it there. Thank you.